on the track, boy.
Hello everyone, and welcome back to Just Accounting series. In our previous episodes, we discussed the definition, history, and importance, and the types of accounting. I am 𝐒𝐞𝐫𝐢, and for this week's video, we will discuss and tackle the accounting cycle. Each step in the accounting cycle plays an important role in creating accurate entries. It ensures the company's financial statements are consistent, accurate, and meet official financial accounting requirements. Accounting cycle has 9 steps. These are journalizing, posting, trial balance preparation, adjusting entries, worksheet, financial statements, closing entries, post-closing trial balance, and reversing entries. In the first step of the accounting cycle is the journalizing transactions. Journalizing transactions serve as the building blocks for the financial records. It is a process of keeping a record of all the business transactions, tracking them in the chronological order, and generally includes a date, the account you're debiting or crediting, and a brief description of the transaction that occurred. Step 2. Posting to the general ledger. After journalizing the transactions, those entries entered into the journal will be transferred to another book called ledger for final recording. A general ledger is an account or record used to sort, store, and summarize company's transactions. Posting simply means updating the ledger accounts due to the effects of the transaction recorded in the journal. Sorting process, which means putting each value in a certain place according to its kind, class, or nature. Step 3. Trial balance preparation. Trial balance is a bookkeeping worksheet in which the balance of all ledgers are compiled into debit and credit account column totals that are equal. Footing means the process of adding each of the 2 amounts columns of an account. Remember, a trial balance does not prove the transaction have been correctly analyzed and recorded into the proper accounts. This proves only one aspect of the ledger, that is the equality of debits and credits. Step 4. Adjusting entries. Adjusting entries are journal entries which are to be recorded in the general journal and are usually prepared at the end of the accounting period of 1 year following the preparation of the trial balance. Generally, adjusting entries are prepared for the following reasons: to bring records or balances accounts of updated, to properly match revenues against expenses during the period. Step 5. Worksheet. Worksheet or working paper is a columnar sheet used as a tool or bridge connecting the trial balance and financial statements. Its purpose is to determine the performance and financial condition of the enterprise in a fast manner, even before adjusting and closing entries can be recorded in the general journal. Step 6. Financial statements. Financial statements are written reports created by a company's management to summarize the financial condition of the business over a certain time period. These are the financial statements that must be prepared in accordance with the specified standardized accounting to ensure that reporting is consistent at all levels. Step 7. Closing entries. The work of an accountant does not end after the preparation of financial statements. Closing of the book of accounts signaling the end of the accounting period, and the preparation of the post-closing trial balance to ensure the arithmetical accuracy and correctness of the balances of account after closing entry has been done, and to facilitate the preparation of the new accounting period. Step 8. Post-closing trial balance. After closing all the nominal accounts, another trial balance is prepared to prove the equality of debit and credit amounts of accounts remaining open in the general ledger. The post-closing trial balance therefore contains the list of statement of financial position accounts with open balances, and is being defined as a statement of financial position in a trial balance form. And the last step, reversing entry. Reversing entry is a journal entry that is being recorded in the general journal and is done at the beginning of the accounting period after the preparation of the opening entry. For a company to operate for the first time, there will be no reversing entry at the beginning of the period that only takes place from the start of the second year of operation. For the most part, the accounting cycle focuses on historical events and ensures incurred financial transactions are reported correctly. That concludes this week's episode. I hope you had a good time learning the accounting cycle. And once again, I am 𝐒𝐞𝐫𝐢𝐞𝐬. Be sure to follow us on our social media accounts and subscribe to our channel. Like, subscribe, and click the bell button to get notified in our next video and learn the accounting cycle.